from last year, the bond market at one point had never performed as you had to go back to the 1700s. So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down. You listen to corporations out there, even those who have had pricing power, the staples, P&G, they get their pricing, but they lose the volume, 6% declines in volume for a staple company. So we do think the consumer is railing against inflation, and the Fed certainly is doing its part, and money supply growth is down. Our estimate is roughly 3% on a year-over-year basis. We haven't seen a decline in money supply since the Great Depression in the 1920s.
Bitcoin price broke above $25,000 on Feb 21, accruing a 53% year-to-date gain. At the time, it made sense to expect the rally to continue after U.S. retail sales data from the previous week vastly surpassed the market consensus. This fueled investors' hope for a soft landing and a possible averted recession in the U.S. economy. Hello and welcome to Money Talks. In today's video, Cathie Wood, CEO of ARK Investment Management, updates about the recession fears and the current market cap of the crypto industry and reaffirms her firm belief in disruptive innovation.
So you see these most recent hawkish hand-wringing as, the death gurgle of inflation, one last attempt to try to make its voice known?
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
The market has sort of changed its mind from your view, and now thinks we're going to have a series of more interest rate hikes, and they're going to have to stay higher for longer, and the economy is going to get hurt worse than expected.
Yeah, this is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long-term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to 1 over the full year. So if they bumped the numbers disproportionately in January, it'll come out of I don't know.
The apex of the U.S. Federal Reserve's strategy success would be increasing interest rates and scaling back its $9 trillion balance sheet reduction without significantly damaging the economy. If that miracle happens, the outcome would benefit risk assets, including stocks, commodities, and Bitcoin.
It's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust, and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. The costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
Unfortunately, the cryptocurrency markets took a hit after the $25,200 level was rejected, and Bitcoin price plunged 10% between Feb 21 and Feb 24. Regulatory pressure, mainly from the U.S., partially explains investors' rationale for the worsening market conditions.
In our flagship strategy, which is ARKK, Tesla is our largest holding. But if you look at ARKQ, which is our autonomous technology and robotics strategy, we also own other names like BYD in China and XPeng and a little NIO as well. Now, why do we think EVs are the place to be? Well, we are analyzing battery technology, but more important, drivetrain technology, which includes batteries. And if you look at the cost curves associated with drivetrains, what you'll see is that for every cumulative doubling in the number of electric vehicles produced and sold, costs decline by roughly 28%. And it seems as though already the total cost of ownership of an electric vehicle is lower than that of a gas-powered vehicle, which means, which helps us understand why last year electric vehicle sales globally were up, I believe it was 62 or 64%, while gas-powered vehicles were down about 7% globally.
In a Feb 23 New York Magazine interview, Securities and Exchange Commission Chair Gary Gensler claimed, "Everything other than Bitcoin is potentially a security instrument and falls under the agency's jurisdiction." However, multiple lawyers and policy analysts commented that Gensler's opinion is not the law. Hence, the SEC had no authority to regulate cryptocurrencies unless it proved its case in court.
So the electric vehicle shift is underway. Consumers want electric vehicles, a total cost of ownership cheaper. So last year, there were 7.7 million electric vehicles sold around the world. We think that number is going to 60 million in the next 5 years. Now, the consensus estimate is that it's going to only 20 million. So there's still a big gap between where we are and where the consensus view is. That 60 million, we believe, will account for 75% roughly of all vehicles sold in 5 years. So electric vehicles, very important. Now, many people focused on Asia say, wait a minute, BYD is winning here. And if you look at last year's sales, BYD's sales, if you look at hybrids and battery electric vehicles, they were up 211% to roughly 1.8 million units, whereas Tesla's vehicle sales were only up 40%. And so the question from Asia is, well, isn't BYD ahead of the game here? You might say yes, based on those statistics, but if you take out hybrid vehicles, and we think hybrid is going away. Hybrid is 2 systems in one, much more complicated, much more costly. And you look on that basis, BYD's pure battery electric vehicle sales last year were 900,000, whereas Tesla's were 1.4 million around the world. But electric is not the whole story here. In fact, from our point of view, when it comes to Tesla, their autonomous strategy, autonomous taxi platforms, is much more important than their electric vehicle strategy. In our view, our $1,500 price target for Tesla, it's a little over $200 now, but our $1,500 price target in 5 years is 2/3 because of autonomous. And when we listen to BYD, we do not hear autonomous as a strategy. We hear it more with XPeng, but again, they, from a unit volume point of view, are far behind BYD and Tesla. So that's how we're looking at the world right now.
So, what are your thoughts about Cathie Wood's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.